Steve Brown, REITs have made a big comeback in the last 2 weeks as a lot of people think that the Fed is on the sidelines. The IYR, which is the ETF that tracks REITs, it's up around 6% in the past 2 weeks. What's your perspective?
Okay, that's a great question. REITs got off to a slow start in January because of the concerns of 3 or 4 rate hikes this year. And as we've moved into the year, what's happened is that obviously international growth has slowed down and U.S. growth is adequate. So the question now is, are we going to have another rate hike this year? And now that we're having that conversation, REITs have caught a bid. They've got good fundamentals, and they're acting a lot better right now. And I think that'll continue for the rest of the year.
Well, one REIT you like in the American Century Real Estate Fund is Kymco. They own a lot of retail properties, a lot of shopping centers. There's a lot of worry about malls out there because of anchor tenants, but it seems though there's more confidence in the shopping centers. Why don't you talk about it?
Sure. Yeah, the differentiator with Kymco is they own community shopping centers, not regional malls. So they don't have a lot of exposure to, say, a Nordstrom's, a Sears, a Kmart, a Macy's, et cetera. They're more of a Target, Walmart, Home Depot type operator of retail properties. And that property type has seen rising occupancies for the last couple of years. So they've got good occupancies, limited new supply, and good fundamental product for Americans, groceries, home improvement. And I believe, and one theory we have is that this year, 2016, the middle 80% of the country is going to be the big winner because of lower gas prices. Maybe Wall Street has a tough year, so the top 10% of the population is pinched a little bit, but the drop in gas prices, and there's many places in the country where you can get gas for $1.65 a gallon now, that's a benefit mostly to the middle class and the lower middle class. So I think at Kymco, with the Walmart anchored or the Target anchored centers, is really primed to benefit from that.
Well, you're also bullish on Store Capital. This stock's up around 7% year to date. They're in the sale-leaseback business. So if you have an independent store, they say, you run your store, we'll own the property. So it seems like this model is really taking off.
Yes, this is a big winner so far this year, up 7% in a down market. And what they do is they invest in net lease properties. So they don't manage them, they just invest in them. And what they focus on is credit. They're excellent at underwriting retail and shop credit. So if you're concerned about credit in the United States in 2016, here's a company that emphasizes credit underwriting skills. They have investments of 7 or 8% on the net lease properties, so they have good growth and a good current yield. It's a good story. It's working so far this year, but I think it'll continue to work this year.
And then the final REIT that you like is Equinox. This is a data center REIT, and we all know we need more data centers because there's more data being created. That said, for a REIT, it pays a dividend of 2.3%. You can get much more in some of these other names, 4%, 3.5%. So why go with the lesser yield?
Okay. Equinox is a technology REIT. It's a real estate investment trust. It is in our index, but they're a beneficiary of the growth in data and wireless services and cloud computing. So they're more of a growth-oriented REIT than a high-yielding REIT. So they are constantly reinvesting and growing their portfolio of both data centers and towers. And so they have above-average growth, and they're a beneficiary of just the growth in online activity, but also in cloud computing. So if you think putting things on the cloud is going to continue to grow, here's a primary beneficiary. They are a real estate investment trust. They do have a yield, but they're going to be a beneficiary of the growth in cloud computing.
All right, well, thanks a lot, Steve.
Thank you.
Thank you for watching The Street.